Hey, good morning. Let's go over today's trade plan. So in the overnight session, we saw that buyers were very aggressive and active, and ES ended up moving all the way up towards the 77, 78 area, where responsive sellers were active. At this point, we know that the larger time frame bias continues to be bearish, but short term, holding above 66 to 68 half could lead to a retest of 75 quarter to 77 quarter, and even 81 to 83. Now, in order to get a sustained upside breakout and in order to even hold above 66, 68 half, we are going to need to see some broad market strength and some sustained upside momentum. And without that, the market can quite easily fall right back down into the 57 half to 60 initial support zone and possibly even lower. And that's something we'll have to gauge in real time. Right now, we are running on very high volume, and as we've seen over the last couple of days, that leads to a wider range and just more intraday volatility. So even when you don't get a very large range in absolute terms, you can still get a lot of intraday volatility when you are running on above average volume. And right now we are running on very high volume in this market. This is a bit of a news driven market, and it does require us to be a little bit more careful, but that higher risk also comes with higher reward. And as long as we're being selective and we are picking our spots, there are a lot of very good trade setups in this market. You just have to be patient, wait for some decent location, and there are good trades on both sides, long and short. Now, like I mentioned, the larger time frame bias is not going to change simply because of a small move up. So far, this is simply balancing within a range, and until we get a strong breakout and we actually take out some pretty decent resistance zones on the upside, the larger time frame bias can continue to be bearish. So that means even if we head up, we can still get responsive sellers active on first test of every resistance zone on the way up. And we saw that even in the overnight session. So, for example, Tuesday's initial resistance zone, I believe, was 74.75 to 76.75. And we saw in the overnight session that's where sellers were very active. And now we're just balancing within a couple of zones here. So, even if the market continues to go higher, it doesn't mean that it needs to turn into a trend up day. Now, where we short is going to depend on the level of momentum and how much broad market strength we're seeing. If the advanced decline line is pegged at plus 2,000 or higher, and we're just seeing the tick holding above zero and printing some pretty decent upside values, then we have to make sure that if we're shorting the market, we're getting good trade location. But aside from that, if things are kind of stabilizing a bit or normalizing where the AD is actually trending lower, then ES can also pull back and test the 57 half to 60, and from there even fill the gap at 54 half. Now, first test of 57 half to 60 can still attract buyers. A break below 66 would indicate a failed overnight breakout. So off of 57 half, a move up to 66, 68 half would present resistance first time up. So off of 57 half, we just have to see, are there enough signs showing us that we can actually go right back up to 75? Is there still enough strength in this market that we can actually go up towards 75? And if we're not seeing that, or if we're just seeing, big downside momentum, then 57 half to 60 would be a better zone to use as a target on the short side rather than entering long, although the expectation is to get at least some sort of rotation and bounce off of 57 half to 60 on first test. And in a volatile market, we know that even the intraday rotations, the intraday bounces, and just normal swings are going to be bigger. So, you can quite easily get just a 5 to 7 point reaction at these zones too. And we've seen that even in the overnight session, that even the reactions have been fairly decent. So, with this higher volatility, even a tradable reaction is actually netting us, bigger profits. Now, when you're trading in a high volatility environment, make sure that you are adjusting your stop size to account for the increase in volatility. So in this type of market, what I'm seeing is 2.5 to 3 point stops are working fairly well for most of the trade setups. And if you start going too tight on the stop loss, then you risk getting stopped out prematurely just based on some random noise at the zone. So make sure that you are setting the correct stop size when you're initiating these trades. Otherwise, you can run into a situation where your trade idea actually works out, but you get stopped out first, and then the market goes where you thought it was going to go, and goes in your favor. So important to actually place the stop at a short-term invalidation point rather than using an artificially tight stop in a high volatility environment. And just because you're using a wider stop doesn't mean that you're not getting good reward to risk, because the overall volatility expansion means that we're also getting bigger swings, so it makes up for it. And actually, there's more reward potential because of it. So, off the open, we're going to keep an eye on the 66 to 68 half. That is really going to help us establish the short-term directional bias, but with the understanding that the larger time frame bias has not shifted yet, and that can continue to be bearish even if we get a break above 75 quarter, 77 quarter, and technically even above 81.83. Even if we break out above 81.83, the sell side can still be active at the zones above at 87, 89 half, 92, 94, and by then the market would be exhausted anyway. And then we have strong resistance at 98 quarter, 2175, but that's pretty far away right now and not really on the radar or in play. On the downside, like I said, 57 half to 60 is going to be the high odds objective, as long as we can break below 66, 68 half. But if we're going down on heavy momentum and the AD is tanking as well, then we can also fill the gap at 54 half. That also marks the overnight low, so that's a short-term inflection point. And then the major support is really at 47 to 50. That marks the bottom of the recent 2-day range, and that's really the main inflection point that buyers have to defend at this point if the market is going to stabilize and actually go back up. If you break below 47 to 50, at that point that would mark a break below the recent 2 to 3 day balance, and then we can get even long liquidation down into the next zone. But in order for that idea to play out, in order for the market to actually liquidate below 47 to 50, you would want to see a lot of weakness on the advanced decline, some sustained downside momentum, the other markets showing a lot of weakness as well. And if you don't have that scenario, if those underlying conditions are not present, then 47 to 50 can just hold, just like yesterday. Now, the more times you test a zone, the weaker it is, but that has proven to be a fairly strong area of support, and we are going to have to see some clear-cut signs of some decent weakness if we are going to break 47 to 50. But until then, the market is trading within a balance. We need to be flexible and nimble with our short-term directional bias. As day traders, you can't really afford to be a bull or a bear. You need to be willing to take the right setup irrespective of direction. So wherever you're seeing edge, if you're seeing signs that 57.5 to 60 is a area that the market is now exhausted into, and we're not seeing any major weakness, then that can be a long setup. At the same time, on the upside, if you break out and go to 81, 83, but now you're short-term exhausted into it, and let's say the other markets are also hitting a resistance area, that can still be a short setup on the day time frame. As day traders, you need to be willing to go long and short and not get tied or locked into any single direction. That just means that you're going to be skipping a lot of opportunities if you do that. So to get the most out of this volatility and out of the market, it's going to be best that you are flexible, nimble, and willing to go long and short on the day time frame, because there are going to be opportunities on both sides. The only time that you want to focus on just a single direction is when the underlying environment is indicating a trend day. Every other time, you'll find opportunities on both sides of the market. So understand the context, bigger picture. We're still in a range. We're still technically bearish on the larger time frames. Short term, if we hold 66, 68 half, the buyers are more dominant and we can go higher. So there is kind of that mix of the directional bias, larger time frame bearish, smaller time frame bullish above 66 to 68 half, below that more neutral, and that's why you have to be willing to jump in long and short. Just make sure you're getting good trade location and that you are actually using a proper setup to get involved. So those are the main ideas heading into the open. Let's see if the sellers can re-enter the market this morning and press and take ES down to 57.5 to 60. That's going to be the primary downside objective, and then we'll just see kind of how the market is shaping up at that point to determine whether it's still more of a balanced market or whether it is a directional market. On the upside, if we keep on holding 66, 68.5, just know that we are going to have to see some continued strength on the advanced decline and the NYC tick in order to actually sustain these higher prices. Otherwise, by default, because the larger time frame is bearish, we can quite easily pull back into the initial support zone and even the gap fill. So those are our main ideas. Let's see if the sell side presses or if the buy side maintains here. That'll help us set the buys for the day, and we'll take it from there.